Welcome to Logan Anderson's Millennial Debt to Income Calculator. We're going to quickly go through and show you how this works so that you get a better understanding of the information going in and the information coming out. We're going to start with your mortgage or rent payment. Since we're talking about buying a home, what we want you to do is put in your total monthly principal, interest, taxes, and insurance all added together in this block. We're going to start with $1,000 a month just for an example, and you'll see it populated over here to the right. We'll get into that in a moment. You can either tab down or click down and you'll see the credit card debt. Add up all your credit cards, write it down on a piece of paper, for example, Visa, MasterCard, those kinds of things. Whatever that total comes to, we're going to put $100 in here just to fill something in the block. You won't do that, of course, unless you have something to put in there. Homeowners Association, if that applies to you, put something in there. Let's put in $60 a month in there. If you have any auto, boat, RV, motorcycle loans, any type of loans that are secured, and those loans will report to a credit reporting agency, put in that amount. We're going to put in $300 here. We're going to put in, for college loans, 0. Hopefully you don't have any. If you do, put in the minimum amount that you're required to pay. If you have a secured note or personal loan that shows up on a credit reporting agency report, not something you owe your parents, but a credit reporting agency report, put an amount in there. Right now we're going to skip this and say that there isn't anything. All other monthly obligations reported to credit reporting agencies. Anything else that you know goes to an agency, which could have been some type of a debt in the past that you're still paying on, put in that minimum payment. We have now come down to the total reoccurring monthly debt, which is simply adding up everything that you see from the top right here all the way down to here. And this is the total, $1,460. You notice over here, this is what we call the front end debt, which is $1,000 for rent and homeowners association. So you can clearly see right here, we're only tabulating the cost of your property that you live in. Okay? The next thing we're going to do is take your income from salary or job. If this is a joint application, just put the two together. We're going to put in $5,000 a month here for this purpose. Let's say there's two individuals making $2,500 a piece. We're going to come down to interest, dividends, annuity income. Let's just say that you earn about $25 a year in some minor amount of interest, dividend income, and 0 for child support unless you have child support. That's income, by the way. Income from investments. You could have some stocks, you could have bonds, you could have mutual funds that will pay you a monthly amount in or a quarterly amount. If it's a quarterly amount, you divide it by 3, obviously, then you put in the monthly amount. So we're going to put in that you have $50 from income in investments. Other sources would include if you have monthly rental income. Let's say you own a rental property and you have some money coming in from that, or any other source of income that is provable. You must produce documentation to show that you have been earning this other income for about 2 years in order for them to give you a percentage of that as credit. So the total gross income is $5,075. Here we go, $5,000, $25, $50, $5,075 is your gross income. Now, this is calculated that your debt to income ratio percentage, that's all the debt you have from your mortgage payment all the way through everything here, is 28.77%. Now, you need to check with a mortgage loan person, or you can Google this. I will tell you that for purposes here, we're going to put in 50%, which is about the highest that you can have for an FHA 3.5% down loan. They may go a couple of points above that, say to 55%, but we're going to put 50% in here just to stretch that. Not really necessary, as you can see above. And then over here, we have the front end ratio here. And this just simply looks at your housing income compared to your total income over here. And it's 20.89%. The ratio here, a good ratio, is 31%. Now, because we have positive numbers on both ends here, in other words, you have basically 21% left over, which means that on this ratio, you can afford to buy more house or have a higher mortgage payment. So let's go back up to the top just for a moment, and we're going to put in $1,500, and let's see if you can make that payment. And that would be principal, interest, taxes, and insurance. And that works also. You still have a positive number. So you can keep working with this to push that up right to the point where it's at the threshold. If you choose to do that, that might be $1,700 a month, some number like that. Over here, you're right on the line. So you're pushing this, which means that if you go much above this threshold of 1,500, you may be in trouble on this ratio here. Now, depending on the type of loan program you have, there could be some accommodation made here where the 31% might be able to be pushed up to, say, 40%, for example. This will come from your loan broker, who will give you actual numbers. But using these numbers that I put right in here, 50%, 31%, give you a very good idea of the fact that if all other things included, such as your credit score being above 740 and your producing documentation on your income supports what you put in here, you should qualify to buy a house based on what you see here. And the most you can pay at this point is $1,500 a month for principal, interest, taxes, and insurance on that home. You can put in some notes here if you want to. Put in your email address, then you'll be able to hit the submit button and you'll get a PDF of this transaction that you can download. Well, thank you for coming to the Millennial Debt to Income Calculator. This is only one portion. You should go to the calculator that determines the monthly payment on the property that you're looking for, and then take that number that comes from that calculator and put it right here in this block right here. And that's how you start. So this is really the second phase of the calculation that you come to, and then you can determine. Or what I like to use this one for is to push this number around to find out how much I can buy, and then I go in and I put that amount in the calculator and see how much house I can buy. How does that $1,500 turn back upwards into the price I'm going to pay for the house? And that is dependent upon the interest rate and some other terms that are involved. So thank you for coming, and if you have any questions, please submit them to us on the form provided on this page.